Okay, we're gonna go ahead and get started. First off, thank you everybody for joining. We had a record amount of turnouts today. Really appreciate your time on a busy Thursday. Today's presentation is all about HELOC and HELOANs. How do you unlock that potential? Because it is a huge potential, a huge market that we are staring down the barrel of right now. So on today's call, I have very excited to have Lynnette Nuese, I'm sorry.
It's okay.
Lynnette, welcome.
Welcome. Thanks for having me.
And I am Tim Nguyen, CEO and co-founder of BeSmartee. Let's go ahead and go to the next slide. So just real quick, Lynnette, if you could take a quick moment to introduce yourself to the audience, please.
Yeah, so absolutely. So I've been in the business, was in the mortgage business for basically 32, 34 years, did sales, account rep, originated a little bit, just kind of really did everything. And then moved about 4 years ago, moved into the LOS space. And in 2021 came to Constellation and have been here ever since. Really bringing kind of, it's been great to have all that mortgage experience and then come in on the LOS side and learn the technology piece. So I'm very excited to be here.
Awesome, welcome Lynnette, very excited. My name is Tim Nguyen, CEO and co-founder of BeSmartee. I actually started in the mortgage business right out of college. I actually left college a little bit earlier in my junior year, became an originator for a short amount of time and found my home in the back end of the business. Started off in appraisal, title, notary, escrow, eventually got into software, and that is my background. Been born and, well, I don't say born, but definitely grew up in the mortgage biz. It's the only industry I know. Been doing it for, gosh, right about 20 years now, and so glad I joined, not going anywhere else.
Okay, so we're going to get started today, and just to welcome everybody that's on the call. We're going to talk about the HELOCs and software and making that transition and pivoting to that market. But just as a reminder, and we get to the end, hopefully we'll have an exciting enough call for you today. If you stay on to the end, we will have and be giving away 4 Amazon gift cards. So stay tuned for that, and then we're going to get started. So basically what we want to talk about today is just really how this is kind of the perfect marketplace for seconds. And why is that so, right? So if you want to change the slide, Nora, we have a couple of things going on, right? And I kind of call it the trifecta or the perfect storm for seconds. We haven't been in this position in a very long time, but we've got very, 40-year record high inflation that some of us have never been even around for. We've got interest rates on firsts moving up. And then we have this incredible amount of equity that we have in the marketplace that homeowners are now experiencing. So it's really kind of the perfect time. And so the conversation today kind of rolls around, are you ready for that? Are you making that transition? Does your software make that transition seamlessly? If it doesn't, talk to Tim and I after the call. But basically is that we are in that position. So as you go to the next slide, we can see just what does that look like, right? We've got $185,000 worth of home equity in the average American home. That's 48,000 came in 2021. And so we've got this opportunity to be, if you're not already, marketing to your database and really being that mortgage professional, that lender for life, calling those borrowers and saying, hey, let's talk about, are you feeling the squeeze of the inflation? Are your interest rates on your credit cards going up? Are you looking for a new car and all of a sudden the price of that car is higher and the rates are higher than you've seen in the last 10 years? And then just home improvements. And Tim and I will talk about that in a little bit, but it's just the perfect timing to be able to do that. And does your software make that and your technology make that real seamless change with you? If you're if you're a client of ours, that's already true. BeSmartee has right on the system. It's the same application. The borrower just picks HELOC or fixed second, and they take the application like normal, comes into the LOS. It's smooth, seamless, and really simple. So yeah, so perfect opportunity, perfect time right now to kind of see that business evolving into seconds.
Okay. Nira, we can go to the next slide, please. Okay, so big question, right? Why HELOCs and HELOANs today? Why is it the hottest topic in our space? Well, frankly, I'll say this, it's the next boom, right? We all went through the 2020 boom, the 2021 boom, and it ended in the first half of 2022. Rarely do we get a chance to do it again. This is that opportunity. Now everyone's gonna be able to take advantage of it. We got a record $11 trillion in home owner equity. That's a big deal, a record. Consumers don't want to lose their record low first mortgage rates. Again, another record. Refinance and cash outs are a record downward trend right now. The NBA just released their forecast yesterday. Take a look at that if you haven't. Refinance share of volume and transactions, closing transactions, way, way down. It's gonna be like that for the next couple of years. That market is just not there anymore. Purchase demand remains strong. And if you guys remember that thing called piggyback loans, right? The 80-10-10, we think that's coming back. Non-QM is another driver of this. Most of our client bases were flocking non-QM the first half of the year. It really, and some implemented, some didn't. That expectation that lenders and consumers had, it just didn't meet the hype. We think that HELOC HELOANs will. And from a little data for you, out of 1,000 people surveyed, 72% said they'd rather fix and sell their home right now in this market environment. And that's a big deal, right? You got to get that cash out, that tap the equity. And frankly, we also have a lot of people that we're hearing from, especially in my circle of friends and family. They're simply just getting HELOC, even if they don't want to use it. Or they have this equity, and it could be a safety net, an emergency comes down the road. Now you got something to tap.
Yeah, it's easy, quick cash, fast, right? Just have it there if you need it for an emergency.
Exactly. Let's go next slide, please. So just real fast, right before we get to the next section, we're going to spend the majority of our time on the Q&A. We fielded questions from the audience, questions we normally get on, with our clients and our prospects. But before we do that, BeSmartee Constellation, I'll say this about our relationship. It's a relationship. It's a partnership. It's beyond just a vendor integration where we have to integrate with each other. We wanted to integrate with each other. We work closely with one another. Our teams are lockstep in alignment. We have regular meetings. We share roadmaps together. That's the type of relationship you want between your critical core vendors. Lynnette, anything you want to add there?
Yeah, I think we're really excited to have BeSmartee as the POS in our LOS. I think, the type of vendor partnerships that you have, and it truly is a partnership. I think our business philosophies align nicely. We're both committed to the continual improvement of the product. And I think having that great point of sale, BeSmartee, as an originator, I've used systems out there. I really think BeSmartee's best in class. And I think I'm so excited to have it as a feature to our LOS. It just makes our LOS shine that much better. Those partnerships that we have, if they're not good partnerships, if it's not a lights out integration, a lot of times it can cause you heartburn on the other side. So the LOS may be great, but if that partnership with that vendor isn't wonderful, it can cause you some heartburn. So we're really excited and very happy that we're going to have this long-term relationship with BeSmartee.
Thank you, Lynnette. So are we. It's been a great journey the last couple of years. So thank you guys for the partnership. Okay, let's jump right into the Q&A. So this first question, Lynnette, if you can ask.
Yeah. So, Tim, what do you think the most optimal consumer experience is for the second mortgage workflow?
Yeah, so we get this question all the time. We mostly get it from current customers. We get it from prospects as well. And it's a fascinating answer because everyone's got a different idea of what the ideal consumer experience looks like. We still haven't left that phase. I don't think we're leaving that consumer experience, that consumer first mindset for a long time until we actually all get there. But imagine this, all right? This is what our consumers are going through right now. With the right technology stack, the right business model shift, consumers are doing an application. They're choosing a HELOC or HELOAN, a closed-end second. They're answering the most minimal amount of questions. Keep the question sets short, keep the number of pages as short as possible. In that process, there's automation of data, automation of credit, automation of product and pricing and fees. So at the end of that process, consumers, in a short amount of time, usually about 10 minutes, they'll be able to actually see their HELOC options, their HELOAN options, specify what their initial draw is, and really provide that information. All that data, right, then goes into the loan origination system. Now, meanwhile, the consumers, they got their options. That 10 minutes of time that they spent, there's a reward at the end of that, right? They have their instant on-demand gratification. You're able to see the rates, see the fees, and choose an option. And for those clients of ours that are choosing to go lights out disclosures, it goes even one step further. After they choose their option, their rate point combination, or in this case, their HELOC or HELOAN option, they'll go ahead and flow right into initial disclosures. Okay. Lights out. So this can happen at 3 a.m. in the morning, 3 p.m. in the afternoon, whenever. Consumers, especially for a smaller loan amount, smaller product, they're going to want to expect something that's going to be more streamlined, faster. And with the right technology partners, the right strategy, and the right vendors involved in this ecosystem, it's not just BeSmartee, it's not just Constellation. You're going to need your credit vendor, we're going to need your doc provider. We need to orchestrate it with your providers. And if we do this right, you're talking about a 10 to 15 minute application to credit, to product and pricing, to fees, to initial disclosures in about 15 minutes of time. That's the type of consumer experience that consumers are demanding. And if you think about that as well, the type of experience your loan officers want to provide, what your organization wants to provide, it sets you apart. It drives efficiencies in the origination process, but more importantly, also, it drives that downstream efficiencies as well.
And here's another thing that we've had come up the last couple of prospects we've talked to, Tim, is that they really like the fact that the government monitoring information on the seconds can be removed, right? You can configure that so that it's not, because not all systems will do that. So if your system is giving that kind of, again, heartburn, feel free to contact us, because it's very easy and simple to do for the seconds versus first. So.
Yeah, you bring up a good point. It's that configuration, which I think we'll touch on here, but every business can be a little bit different. Every product is a little bit different. You got to get product level, lender level configurations that can really morph your workflow to be very targeted. So thank you for bringing that up.
Yep. And then what do you think about the commission structure for the HELOCs and HELOANs?
Yeah, so we actually do have a question. That question did come up, and we'll talk about it a little bit later. But if you don't mind, Lynnette, can we wait for that towards the end?
Yeah, absolutely.
Yeah, we got some data there.
Let's just come back to it. Yeah.
Okay. Nira, let's move on to the next question, please.
This is the next question.
No, go to the next one.
Oh, I'm so sorry.
Yes,
my bad. I thought this question was at the end. Okay. So, what we're seeing right now is traditionally 200 to 250 basis points. Okay, you can do the math on what that looks like in $100,000 loan. But here's the really interesting thing, right? Is the product has been around for a long time. Okay, now it's booming. What we're starting to see very, very quickly is new lenders, new investors coming up with new products. What this means is eligibility and requirements are going to be different. We're starting to see more aggressive eligibility. We're starting to see more aggressive pricing, and we're also starting to see more aggressive loan officer compensation here. One of our clients right now, I can't let the name out of the bag yet. In Q4, they're planning on releasing a product that they just started originating. That's going to pay about 500, 800 basis points. So contact, if you walk with anything else on this call today, put our name on your list, contact us in Q4. We'll make an introduction happily over to one of our clients and open up a new opportunity for you. But that's what we're starting to see, right? It's where it has been, but we're starting to see upward pressure and more aggression in terms of product, pricing, eligibility, and even commissions.
How about the lenders shift to that market, their ability to shift quickly? What do you think about that? Has that been something that you guys have been talking about, capitalizing on the new market opportunity?
So that's a really good question as well. For our clients, I just know our clients, right? And your clients to a certain extent, because it's already something we support, HELOC and HELOANs and that customized workflow, we haven't seen that issue. What we have seen, though, is just a lot of demand, right? And that demand has led to a lot of new re-implementations, so to speak, resetups, retesting, and getting people live in the product. And if you take the BeSmartee base, for example, it's going to go much faster. Now, when we talk to prospects who are looking to make the shift, it is an issue, especially on the point of sale. With your clients and your loan origination system, for example, it's already natively built in. People may not have been using it, so now it's time to crack open those new pages and screens and go to the user manual, go through training and build processes around it. But at least for our prospects on the POS side of the world, this is new. There's a few that do it, and there's many that don't. We're one of the few that do it. It's native in our system, and we can get that configured for you fairly quickly. So if you choose the right partners, I think the answer is just going to be much more. You'll be more prepared. Your vendors will be more prepared. But you got to look also beyond just the POS and LS. What about your pricing engine? Most pricing engines could. It's time to put that to the test. What about your credit provider? Right? They definitely do, but you're gonna have to go through that paperwork. You have to unlock a different type of credit report depending on the investor that you're working with or the lender you're working with. Same thing with your document provider. You obviously have documents today, they're going out just fine, but you got to make sure you vet out that package, make sure those specific forms are there. So you got to look a little bit more broadly than just the POS and LS. We'll help you walk through that journey. And that's one of the things, we tell our clients all the time, use this as a resource. We have tons of clients, tons of volume go through. We've seen, we're integrated about 150 different vendors. We'll walk you through kind of the pros and cons of each vendor, how we work with them to unlock the full potential. What about you, Lynnette? What are you seeing on the LS side?
Yeah, I think we're kind of seeing the same thing. I think it helps to, have the system, and typically in implementation, if you do those products, we will set that up for you, make sure those doc sets are done so that it's just a simple, okay, I'm clicking on my second mortgage package. Same deal with the point of sale. You have all that set up. If they do seconds, we're automatically going to set up through you guys implementing and having those 4 options: purchase, refi, HELOC, and second mortgage fixed on that initial page, that they can pick on exactly what they're looking for. And then it comes into the LOS. And again, based on what you click for the product that you're doing, it automatically makes that change to the right doc set and all of that. So yeah, nice switch. What about loan officers? How much time do you think that loan officers are taking to decide that what equity products they're going to use?
So to be very frank, we haven't measured this yet. We're starting to put those measurements in place, but what we are starting to see is, at least our philosophy, right? We want to collapse everything, so as much of everything's on one page as possible, right? We want information to flow in centralized. So assuming your product and pricing could, return it, when you run your your first products, you can check a box and include second products as well, right? So that could be included in one run. What we're starting to hear is the education component to consumers, right? What exactly is a HELOC? How does that exactly work? What if I draw now? What if I don't draw later? What happens if interest rates go up more, right? Same with HELOCs, really just educating the marketplace on how these products, obviously work. Everyone knows how a mortgage works. Most people have it if they own a home. But the education component is going to be critical. I think that's a business process, that's salesmanship, that's marketing. But when it comes to actual tools of helping them decide, once you get over that hump, the data is right in front of you. We'll cut that time down dramatically. You don't have to log into multiple product and pricing engines. Make sure that's there, because if it's there, it's going to be in the BeSmartee instance, for example. You're not going to rate sheets and calculating things by hand, right? Those all lead to a poor consumer experience. When a consumer asks, what's the rate? Can I qualify? They want quick answers. If you have thumb through pages and different websites, it takes multiple minutes, it erodes trust, right? Your delivery diminishes, and we want to maximize the delivery, especially when it's early in the relationship.
Right, exactly. And this next question I really like. I think, you probably get the same thing as the vendor side, of course, technology is so expensive. And certainly if it's cheap technology, you're probably going to get what you pay for. I think that what really is costly is if you're an organization that's determined a need and you find that software that's going to meet that need. The real thing here is the adoption of that software. All technology is designed to do is, and what we've seen happen in the mortgage industry, is it brings us more business with the same amount of people, and it allows us to do things faster, cheaper, better. So if you're not adopting that software, that's where it does become costly. You can have all the bells and whistles that you want for your loan officers or tools for your ops staff, but if they're not actually engaged in using that software, and especially when we talk about fundamental market shifts, right? I'm kind of a gal that started in the business when the FHA application was a 4-paged carboned form that we had to manually type on. Right. So the evolution of technology that I've seen in the industry is phenomenal. And what's great about that is that it also created some market shifts. So when automated underwriting came out, right, we had all this, hey, we're not going to need underwriters anymore. Well, in fact, we needed more underwriters because we did more business. All the easy files went through the system quickly, and the underwriters could concentrate on the files that were tougher. And so we did more loans. Fast forward to today, where we have oodles of technology available. And I'm actually shocked at and amazed at the amount of organizations that haven't adopted things like day one certainty. For a relatively inexpensive price of the work number and the form for your phonicity, you can have the ability to exponentially increase the borrower experience by a very little cost. And so really, are you adopting the fundamental market shifts that are out there and the technology that it brings? Are you adopting that technology? Because if you do, it's not really that expensive. It's helping you do more loans in a better, cheaper, faster.
Yeah, you bring
Yeah,
up something that's always fascinated me, right? Is if you look at all the tech brands that we know, LinkedIn, Amazon, Netflix, and E-Trade, whatever.
Right.
If you really look at the way they manage their consumer experience, it is science. It is phenomenal. Every page, every click, 2 minutes here, 30 seconds there, it all adds up to an amazing experience, right? That's the type of obsession they have, and that's what we're competing against. That's what we're being benchmarked against, right? So 3 minutes here, 2 minutes there, don't take that for granted when it comes to the consumer experience. They all add up to one amazing story that you tell and experience that you put someone through. So one other thing, Lynnette, on this question here you brought up is if you choose the right technology platform, right, it'll set you up for the future. And so often we see people choose a platform to solve an immediate need. And a year and a half, 2 years later, they got to choose another platform and go through the same implementation, same changes. What would you say, lenders? How do you prevent that from happening? How do you minimize that?
Well, I think it starts, for us, certainly it starts with a really good discovery call, right? We want to know how you do your business, what your needs are, and then what are you looking for in a 5-year plan, right? What does that look 5, 10 years from now? Do you plan on opening up a TPO channel? Are you going to do correspondent business? All of these things really, we spend a lot of time and energy going through a lot of questions in a discovery call right up front, so that we can tell, are we going to be a good fit for you? Or maybe we're not. And if we're not, no harm, no foul. We part friends and it is what it is. But that is really what you want to do. I've been in calls where the lender has been like, you know what, these are really great questions. I'm going to go back and ask the other vendors that I've been talking to these questions because they didn't bring this up. And so you really have to do an in-deep dive on how they do their business. What are they looking to do in the future? Because all of those things matter when you're talking about, because you're not going to change an LOS every day. You want to make sure that if you're spending the money, that it's going to work for you. And there's only one way to do that, and that is a good discovery call.
I love that insight. I mean, we experience the same thing on our end as well, right? Your AE, no matter who you choose to work with, right? If they're not asking those hard questions, they're helping you, forcing you to think about the future and what that means.
Right.
Dig deep on your own. Right? I mean, so many times in business, well, we'll solve the problem today. When that becomes a problem, we'll have plenty of money and resources. We'll fix it later. Guess what? That never, ever happens, right? There's no better time than now. So moving on to the next question here that we have from someone is, so do you see HELOCs and HELOANs gaining favorability in a rising interest rate environment? And do these products provide a better option in this environment?
Yeah, I think so, especially with what we have going on right now, right? Like I said, with the inflationary numbers, it's making it really hard for people. They're spending more money on food and gas and those types of things. And so as their credit card interest rates go up, yes, we're seeing a lot of our lenders pivot to doing seconds. And if you can sell a HELOC to a customer where you're eliminating some of their pain by putting the second, mortgage in place and having them put those credit cards or car loans, or like we talked about, doing the home improvements, they've decided it's too frustrating to buy, we'll stay here. And putting that all on the second allows them, again, as you know, on a HELOC, it's an interest only payment for typically the draw period, which is 5 to 10 years. Let them make a very manageable payment and allow that then to, as the economy gets better, then they can really work on paying down the HELOC and paying that off. So I think we're seeing that's one of the reasons, that's one of the things that people are talking to them about. We haven't had this inflationary pressure in a long time, but I think it is a good thing to be able to say, hey, borrow from yourself, pay yourself back. instead of the credit card company or the car loan or that type of thing, and then allows them a little relief as well. So again, it's a great conversation to have with a client and have them, and you're the mortgage professional, you're their lender for life. And we just see that option in a raising rate environment be good because it's all about payment, right? It's always about payment, and it makes that payment manageable.
Yeah, that's a great point. I could tell you personally, we're looking at getting one as well. No intent to draw on it,
Right.
but gosh darn it, it's there. Like, who knows what can happen in the future, right?
Exactly.
Opportunities or issues, in our personal lives.
Right.
So next question here from somebody. So this is, it's a pretty broad question here. And we realize you don't have a crystal ball, but what do you think about home values? Because that's such a big driver, right, in the HELOC and equity products.
Yeah, I think that it's, certainly my initial gut feeling to this question was, yeah, they're inflated, right? If you've been a buyer in the last 2 years and you gave the seller another $50,000 or $75,000 over ask price, you felt like maybe you were paying more for the home, but you had to do it just to get the property. But look at those equity numbers again. Remember, it's more than kept up. The appreciation of your home has more than kept up with what you had to pay over asking. So really, I think right now we're just in a unique position where no, they're not inflated. It's there. Now we're going to see some stabling off. We already are. I saw a listing the other day that they reduced the price by a little bit. So we'll see a more normalized market, but boy, we're certainly not going to see values drop drastically. I saw a headline the other day that was, oh yeah, they're dropping, and it was like 0.7, it's like, no, it'll be just a more normal market. Your house is not going to sell in a day. And, and that affects, that equity that they have. I think the second mortgage lenders will continue to make those loans because that equity is going to be there.
Yeah, when I was a buyer, I bought a new home about 12 months ago, a little over 12 months ago. To me, the market was inflated. But then I saw my home appreciation go up. I think the market's great now, right?
Right.
But
when you go to get that second, you'll realize that, right? Because the value on your home is going to come out. You'll be like, hey, wow, that's great.
So, real estate's a really localized market. We're starting to see price drops, for example, right in Boise, Idaho area. There's certain markets that are going to be hit harder. In the Orange County market, where I live in California, it's still strong. I check the market every single day. Again, very localized, right? There's certain areas I care about. I want to know about my neighborhood, where my parents live, where I used to live. I'm curious about. And you're right. I mean, it's still strong, but there's definitely downward pressure. We'll see what happens in the next 12 months. But as of right now, there's still a lot of equity. I think it's going to take a lot to really shave up $11 trillion of equity, right? And we're going to see, different markets react differently. So, as you think about your marketing to equity products and where, consider home value appreciation trends. Right? You may not want to invest it in Boise, Idaho as much as you do, say, in, LA County or Miami-Dade.
Yeah, exactly.
So, again, another leading question coming up here, or a big question. Interest rates. Right. This question comes up all the time. It's on every conversation we have with clients and prospects. What do you think?
It's really, I'm sure it's probably one of those things where nobody cares what I think because I'm certainly not a prognosticator. Honestly, I don't think rates are going to do anything unless we have a deep recession. Obviously when the economy tanks, we typically do well. We see rates come down. But again, we've got this inflationary pressure that most of us haven't ever seen. And so it'll be interesting to see what happens there. I don't think we're going to get back to 3%. I just don't. I could be wrong. But I think we'll kind of see that upward climb a little bit in rates to what.
Yeah, if I can add to this, I hope we don't see 2% and 3% anymore, because then that's a really bad sign of other things going wrong, right?
Right.
I tell our company all the time it's not a high interest rate environment that we're concerned about. It's a volatile, rapidly increasing environment.
Exactly.
I use a comparison of Venice, Italy. Right. If the water was still rising, no one in the right mind would be building there. But it rose, it stabilized, and people adapted. We'll do the same with higher interest rates. But this is really critical, right? I mean, if you look at the NBA, forecast that came out yesterday, they think we've mostly peaked, and the mortgage industry is really good at kind of hedging against, the 10-year. And they have 2023, 2024 kind of mostly up and down just a little bit. Take a look at that if you haven't looked at it yet. It's publicly available on nba.org. But what that tells me is we're moving towards potentially a more stable environment. and
Right.
the rates are going to be what they are. Will they go up? We'll see, right? No one
Yeah.
knows.
And you got to do business in any rate environment, right? I certainly, in my experience, I can remember 9% seems like a very high interest rate right now today, but we still did loans. It's just you just do loans no matter what the market is. So yeah.
So this is an interesting question, Lynnette, but very valid, right? Because we have a lot of new entrants into the space. Do you see HELOCs and HELOANs being handled by the mortgage division or the consumer division, banks and credit unions? Obviously, for non-banks, it's going to be the whole org.
Right. Yeah, it's really depends on the financial institution. Some of them separate it, some of them don't. Here's another kind of going back to the cost of the technology, right? We tell our prospects, hey, if you have a consumer division, if that's how you've separated your business, the consumer division does those loans, guess what? You can use the same software, spread it across the organization cost-wise, because of the fact that it's a simple credentials that you set up for these consumer division to get in. Again, have their customers do a great borrower experience to application up front, run into our LS. You just give them access to the screens that they need to see and do to finish that loan up, and boom, business as usual. So you can actually use the software in the same way, whether you separate your division by consumer and mortgage or not. And that's just really how we talk to our clients. It doesn't matter if you separate them. You can still use the same great software. It's probably better than what they're using on their core. And it just allows them, you just give the right credentials to the right screens that they need to see, and away you go.
Yeah, if I can add to this as well.
Yeah.
About a year and a half ago, one of our biggest clients went live with the product. Big international brand, north of $2 trillion in assets. And they, at the time, what they did was they took HELOCs and the home equity products and moved into the mortgage division. It was a very
Gotcha.
explicit decision. We thought it was kind of unique. We usually see it separated out, like you said.
Yes.
It varies.
Yeah. Right.
But over the course of, say, last 3 months or so, we're starting to see a lot more shift from the consumer side of the banks and credit unions and moving into the mortgage side. And I think it's happening for a couple of different reasons. Strategically, as a consumer, as a member or client of the bank, it makes sense, right? You're dealing with someone's homes,
Right.
mortgage, HELOC, hey, you're putting something on my home, so it's a home thing, right? But
Right.
the other thing we're starting to notice too very rapidly is, there's been a lot of downsides happening in mortgage departments, mortgage companies. Right. They're starting to find this as a way to bring in new revenues and new opportunities to retain their best people. And I think that's a trend that we're going to start seeing. Right? There's great people that've been there for 5 years, 2 years, 10 years, whatever. Don't want to lose them. Here's a new revenue stream to keep them around and really help them make a good, strong, be a good, strong contributor to the business.
Right. Exactly. Oh, well, you mentioned this a little bit earlier, Tim, on the 2022, the growing non-QM hype, and these loans adding or overtaking that rush earlier in the year. You want to comment a little bit about that? What your thoughts are?
Yeah, I did touch on this a little bit earlier. So at the beginning of maybe even towards the end of 2021, but definitely in the first quarter of 2022, before the war in Ukraine, this was all the rage. All we heard was, we think non-QM is going to be 50% of our business. Some people, it's about a $50 billion origination, channel. Some people say this could be a $250 billion, 250 billion. Some people thought it could be more like 100 billion. I haven't actually looked up those trends lately to see how it's trending. But what we are seeing, though, is that hype, that demand, that desire, that need to move into the non-QM is not as strong. Right. One of the biggest things I hear from our clients is, yes, we've adopted it. Thanks for helping us with the workflow. But it's really hard to educate the consumers on this product because they're walking in there thinking, regular conventional govy loan, right. Explain them why the rates are higher, why, this and that. They just don't get it. Right. It takes a lot more education to help people understand that the risk in a lot of cases feels really risky. Like, wait, you just need bank statements? Like, it just doesn't feel right. Right. It is right. It is true. But consumer, just knowledge of it all. But yeah, this time around, the HELOC HELOAN hype, I'll call it for now, I think the hype is going to be a boom. It's a proven product. There's so many driving global factors that we talked about earlier that I think can give this thing some legs.
Yeah. Exactly. I agree. Yeah. And I think the, like you said, the boom that I think it'll continue here. I think we're going to see it strong through this year. Again, it depends on what happens with first mortgage rates, but really, I think it's always been a tool in the tool belt, right? It's always been a part of our, like we said earlier, piggybacks. We've always used seconds. It's just we've been so blessed in the last 10 years that rates have been so low on first that we really haven't talked about seconds in a long time. But I think that what's here, the trifecta of what we've got going on here will stay. And so I think they're going to persist here in our marketplace for a bit and really be a factor. And like I said, really kind of helping you to continue to do business when the other side drops off, as it has.
Yeah, it's interesting. I want to go back to a comment I made a little bit earlier. Like, this is the next boom. We think it is, right? We're betting a lot on this. And hopefully the factors that we've talked about lead you to at least consider that this could be a very strong potential. And I think that we got a couple years left. Our sales team asked me this earlier this week, and it's like, hey, when's the last time this happened, what product did we switch to and how long did that product demand last? And the only example I could think of was the Great Recession. The out A's, the subprimes just went away overnight when New Surgery went under, right? If you remember that, that's that was the canary in the gold mine, or the coal mine, I should say. And then most people switched over Govy loans, right? The FHA loans kind of took over. We had about 2.5 years of that demand. It lasted a lot longer than many people think. And after that point, I haven't seen the market shift that quickly yet. Right, going from conventional to FHA was a little bit easier. Going from the market we just had over to non-QM a little bit harder. Going from that market to this market arguably will be, as difficult. It's just a different product, different model, different revenue model, different commission plan, right? But I think we, based on what I'm seeing, I think we have about 2.5 years. Some of the key factors: appreciation, equity, the first rate mortgage, interest, right? Those two are probably gonna be the biggest demand.
Yeah. And housing's still strong. I mean, we still have the demand for housing is still there. We're not seeing that. Of course, when we talk about seconds, then that kind of leads into, turn times that second mortgage lenders are having right now and that type of thing. Have you heard any rumors or grumblings about any of that, Tim?
Yeah, we have. Neera, we can go to the next. Thank you. So I won't mention any names, obviously. So that's not cool. But we are starting to hear, because of the record demand that these lenders are having, their closing times are just running long, whereas those used to be much, much faster, right? 4x in some cases, 3x in some cases.
Right.
So this question came from a broker, I think, if I recall. So his question was, right, like, how do you move this from one lender to another? So if you collect the application in the POS to start off with, make sure that POS could transform that data into an industry format, okay? In this case, our current industry format is a MISMO 3.4. And there are provisions in there for HELOC HELOAN attributes, but there are also missing some HELOC attributes, such as initial draw, right? So you wanna make sure that your POS vendor is able to modify that MISMO a little bit. And then what we gotta do is make sure it goes into the LS correctly. Right, so make sure that the POS and LS have a good relationship. So you have to rekey data, and especially the critical data. You gotta understand metadata and miscellaneous data, but initial draw, boom, that should be there, right? The draw, all that, should be there. And then we got to talk to those lenders that you're doing business with as well. They should be expected to take an industry standard file. Sometimes these lender systems have been, modified and built over years, so they might have to tweak it a little bit. Make sure that, especially if you're working on POS or LS, that the ability to modify that payload that goes to the wholesale lender can actually be modified a little bit, right? We're talking about reasonable modifications. We're not talking about creating a new standard here, but like some people are using the loan amount as the initial draw amount. Some LSs, some lenders aren't reading it that way. So what we've done with our LS partners and our lender partners is we've had that conversation. How do you want this data? Okay, we can go ahead and modify that for you. It's gonna take some lead time, right, to work through both technology departments, but that ability needs to be there to really make your technical efficiencies really, carry that long term.
Yeah. And I've even advertising this, on the social media that we have. I've had people contact me and say, "Hey, do you know any good investors for seconds?" So we're kind of spurring that as well to say, "Hey, who's out there that I can do my seconds through?" And so it's all good conversation. And we're coming to the end. I know we've kind of run over on time here, so we are coming to the end. We do want to do the drawing. So certainly, if I call off your name, please, we'll make sure that you get this card for you. But I'm going to just kind of spin the wheel here a little bit and give you the first name. Pauline Lee, if we have Pauline was available. And then spin again. We've got Nicole Schmidt. One, so hopefully Nicole is on. And then Jeff Henderson is available. And then Trent Ford.
Awesome. Congratulations, guys. Thank you for taking the time and staying on with us. You'll receive an email and send you your gift card. Thank you for doing that, Lynnette and Constellation.
Thank you.
For our audience.
Yeah, absolutely. Great partners. Thank you so much, everybody.
Yeah. And just lastly, I want to make sure that everyone has our contact information. You'll see there on the screen. There's my email. There's Lynnette's email. If it's too small, I can't write it down. Just remember sales@BeSmartee.com. If you want to be connected to Lynnette, let us know. We'll connect you. If you want to be connected to lenders that are offering HELOCs or will be offering HELOCs, let us know. We'll get you in contact with the right people as those products become available. We're here to not just sell you software, right? We hope that you take this away and understand that there's an opportunity here. It'll be your decision how good of an opportunity this is, but we think it's going to be pretty strong. Help you capitalize on it, and we'll help you connect all the dots, where the software vendors, lenders, best practices. Reach out. We're here to help. Thanks, everybody. And thank you, Lynnette.
Thank you so much. You bet. Thanks, Tim. Appreciate it.